Welcome to the Facts versus Feelings podcast. I'm your host, Ryan Detrick, and I'm joined by my co-host, Sonu Varghese.
Cutting through the noise in 30 minutes each week with Ryan Detrick, Chief Market Strategist, and Sonu Varghese, VP Global Macro Strategist, taking out the boring and helping investors focus on what really matters. A quick note before we start the show. Investment advisory services offered through CWM LLC, an SEC-registered investment advisor. Carson Partners, a division of CWM LLC, is a nationwide partnership of advisors.
Hi, everyone. Welcome to the latest edition of Carson's Facts versus Feelings with Ryan and Sonu. Sonu, we have a very, very special one today. Where are we exactly right now?
Sunny California, Newport Beach.
It's not so sunny.
It's not sunny.
We'll ask,
yeah,
we'll
it's a little
about
foggy.
That. We are extremely excited and honored to be joined by Dan Ivascyn. And Dan, before we even get there, your exact title is what? Sometimes we want to make sure we get the titles correct here.
It's Group Chief Investment Officer.
Group Chief Investment Officer. Before we even get there, where's the sun? We come to California, Dan. What's going on today?
I think in a few hours it'll come out. It's June gloom in October, but yesterday was quite a nice day. So we're hoping in an hour or two we'll have the sunshine out.
We'll get there. Yeah, we're going to talk a lot. We're going to talk about stocks and bonds, the Fed, economy, all types of stuff here for the next 30 minutes. Should be a lot of fun.
One thing we didn't mention.
Oh.
You said Group Chief Investment Officer of PIMCO. PIMCO. So Pacific Investment Management Company.
That's a good point.
Right, just so that everyone gets. And we always talk about what the credit markets being the smartest people in the room.
We say that often on our podcast. We follow the credit markets, smartest people in the room. We are so honored because you guys are up to $2 trillion, give or take, close enough for government work. Is that
that's pretty
close? $2 trillion. So we're excited to get into it. I mean, let's start there. Right, you run, in essence, a $2 trillion firm. What are some major takeaways from that, and what is your day-to-day exactly, just so people kind of learn a little bit more about you that might not know so much?
Sure. So to be clear, I oversee the investment process here in the portfolio management team. I have a great colleague, Manny Roman, who joined the firm several years ago, that oversees the business elements. So we have a strong partnership. Also, I guess I'm approaching the 10-year anniversary of me taking over the oversight of the portfolio management group. Also have a great team of other chief investment officers at the firm, some of which have been here longer than myself. Mark Kiesel, for example, who oversees our credit area, has been at the firm, I think, 28 years now. So a great team, and we take a team-oriented approach to not only managing the firm, but managing portfolios as well.
What's the first thing you look at when, in the morning, once you're done with your, morning routine, the personal stuff? What's the first thing you look with respect to markets?
Well, I usually fumble around with my cell phone, when the alarm goes off, and as you know, and I don't know if it's the healthiest thing in the world to do, but usually fumbling around and quickly looking at, Bloomberg, CNBC, a quick run through of various news feeds, right when I wake up, and that can be 4 in the morning, 5 in the morning, depending on what's going on that particular day. Then come into work. It's a short commute. That's a good thing. It's actually too short, not too long, which is the rarity here in California. But usually come in again and just do a quick check of markets, meet with the team, on an as-needed basis. But it's usually just a review of the overnight data. The data's mattered a lot. Central banks tell us it matters a lot. So it's usually a quick run through of that data. And then we start the day, depending on whatever is priority at that particular point in time.
So let's kind of get into that. Obviously, yields have been going higher. We all see that. Now, when I watch TV and I listen to CNBC in different places, sometimes you hear, well, yields are higher because the economy's strong. Or you hear yields are higher because future inflation. Or yields are higher because there's no demand. I mean, maybe it's a combination of those. When we see yields so strong like they have been this year going higher, what do you think? What's the main driver for that, you think?
Yeah, so I think it's a little bit of all the factors that you mentioned, and I think you can delve into some more detail to get a more wholesome picture. But the bottom line is that we've made a lot of progress on inflation. Inflation is certainly heading in the right direction. We're constructive on it continuing to head towards central bank targets, but it still remains elevated relative to the last 10, 15-year period. And fixed income investors, continue to be concerned about the inflation dynamic. Economic growth has been very, very strong. We've had a retail sales number, print recently that was much stronger than we in the market anticipated. So it's a reminder that there's a lot of resiliency in the U.S. economy. And with inflation remaining elevated, there's concern that the Fed will need to do a bit more in terms of tightening and perhaps keep rates higher for longer than what markets anticipated. We think that's also contributing to the higher yield environment. And then a third point, and I think an increasingly important point, are concerns about debt sustainability. We're running very high deficits relative to the strength of the overall economy. That's highly unusual. There's some nuance as to why the deficits optically appear higher than they in fact are. One relates to just California. We haven't filed our taxes yet. We got another 1 month reprieve last week.
We heard last night you guys get a little more time to do it, apparently.
So we have even more time. I think a lot of people
think about it.
File in April.
Yeah, this time a lot of people actually got them in, so they made their payments before the extension. So it'll be less uptake than before. But the bottom line is there's some nuance there in around student loans that have kept deficits elevated short term. The reality is we're spending more money than we probably should from the standpoint of fixed income investors, perceptions of overall debt sustainability, and we think that will be an increasing challenge if we don't get deficits under control. And I think that has led to some higher yields out in the long end of the yield curve. Those are three reasons. I think there are probably a few more, but I think those are three primary concerns. One other quick point I'll make, it's really not yet, at least, about inflation remaining high over the longer period of time. You look at break-even inflation rates, they still are very, very well behaved. So we think this is much more a story about technicals, debt sustainability, higher real rates, and more short-term challenges with inflation. The markets still remain fairly confident in central banks being able to ultimately get inflation under control.
Bringing it to the economy, you mentioned the economy has been resilient, and we got that recent retail sales print, which is much better than expected.
2 months in a row.
Yeah, 2 months in a row. And yeah, they revised up previous months, right? I think July and August. So why do you think the economy has held up as strong as it has, especially in the face of the most aggressive Fed since I think the early 80s?
Yeah, so there's been just a lot of post-COVID enthusiasm. I think this reopening process has had a more significant impact on the economy than people originally anticipated. I still think there's a lot of fiscal stimulus in the hands of consumers and even corporations. We're seeing that get spent down or eroded through higher inflation, but we do think that has had an impact. Probably the biggest issue relates to policy lags. We always know monetary policy happens with
long and variable lags.
Long and variable lags. And I think that they're longer and perhaps even more variable this time. And the simple reason for that, as we all know, is that this has been a real short cycle. You had a COVID pandemic shock, rates go essentially to zero, and huge segments of the economy being able to lock in incredibly low rates, whether you're talking about 30-year fixed rate mortgages or investment grade or high yield rated corporations being able to lock in these low yields. So thus far, despite the fact that interest rates have gone higher, particularly in the front end of the curve, it hasn't had the same type of impact. We have very few adjustable rate mortgages, at least in this country, relative to history. And you had such a low rate environment that you've seen this lock-in effect. So we think monetary policy is having an impact. It's just moving very, very slowly this time. Another point is that we know that private credit markets have grown quite significantly. They too are much more sticky in terms of overall marks and at least the short-term reaction to policy. So we think those are some of the factors that are leading to an extended cycle and therefore more resiliency across the economy, at least over the short term.
Digging into the idea of the economy, we've got this, I don't know if it's called the new economy or the old economy. Let's just call the old economy last decade, right? 2% inflation, 2% growth on GDP. Now this obviously decade, we're seeing much higher inflation. We talked about that, but it looks like more economic growth as well. What is you think the path of inflation in the economy going forward? Is it going to be more like the last 2 years, or are we going to go right back to 2% inflation to 2% growth like we had last decade? Because the Fed keeps telling us 2% target on inflation. We're both a little skeptical we're going to see 2% inflation going forward. Love to hear your take on that.
Yeah, I think things will be different. We don't think we're going back to the pre-COVID or pre-pandemic world of incredibly low real interest rates and incredibly low inflation with all the focus on, combating disinflation or deflationary pressures. Right. We think we're in a different world. We don't think it's that different, but let me be clear. We do think equilibrium inflation rates will likely be higher. So we do think that central banks will eventually get inflation back down towards target, but inflation will likely be higher than it was pre-COVID.
And maybe more volatile too?
It absolutely more volatile. So we do think that you're going to have more inflation volatility, probably more real economic volatility, less ability for policymakers to suppress volatility like they did during much of the GFC recovery period. And you also probably have higher equilibrium real rates. I don't want to put the audience to sleep today, so we're not going to get into R-star discussions for too long at least. But we do think there's some reasons why real rates will be higher. Higher global debt levels, more need for physical investment to deal with climate as an example, regulatory impact on how capital is allocated across these sectors, reshoring, geopolitical risk, outright war is going to lead to less efficient flow of capital around the globe. All of these factors, including even demographics, will likely put some pressure on real yields over the long run. So if it was pre-pandemic, you could think about neutral real rates, somewhere in the front end of the curve near zero. Perhaps they're 50 basis points higher or 0.5% higher, maybe even 1% higher in the extreme. That would be quite significant. But it's at least possible. So we do think we're in a new world. We don't think we're necessarily in a world of uncontrollable inflation, a massive spike in real yields, at least in this country. But we do think it's a different world, and people should not think about reverting back to the old normal. I do think we're in some semblance of a new secular type environment.
So we're being joined by Dan Ivascyn, the Group CIO at PIMCO. This is the latest Facts versus Feelings with Ryan and Sonu. Sonu, go ahead. Just wanted to remind people how important this is and so awesome this is. You're taking some time with us today.
Speaking of that, like you talk real yields, and so real yields, just for everyone listening, is your nominal, the usual interest rates you see minus inflation expectations, right? So coming to those inflation expectations, and he said there could be more inflation volatility in the future, and we think about bond markets. Now PIMCO is a big part of the bond market. How do you price that? Like when you think, okay, inflation is going to be more volatile in the future, along with all the other structural issues you mentioned, higher deficits, things like that. There's demographics too, right? And aging society. How do you put all that together and say, maybe the 10-year interest rate shouldn't be 3%, it should be 4 or 4.5 or 5%. How do you think about that?
What we try to do is we try to break down the components, as you mentioned, as to what goes into a nominal bond yield. The good news is we have things like the TIPS or the inflation-protected bond market that give you a sense of, a real yield versus an inflation break-even rate. Now you have to adjust for liquidity and all, but we do try to think about, the key pieces that add up to the ultimate nominal yield. So real rates, as an example, we think that they're likely going to be higher this cycle, on the order of 0.5% or so in our base case thinking. So, instead of a zero real yield world, we think we may be in a 0.5% real yield world. Then we add a term premium to that. We do think that there'll be some normalization in the yield curve relative to what we grew to expect pre-pandemic. Some of that just related to higher global debt levels. So we'll look at a term premium, let's just say, a 1% term premium if we're looking to come up with a fair 10-year type yield.
And just for everyone, term premium is, you have the choice of investing in, say, a 10-year bond or, taking 1-year bonds and then doing it year after year after year. And because you're going long term with the 10-year, there's more uncertainty. That's sort of captured in the term premium, as you called it.
That's correct. So it's compensation for uncertainty around how much debt is going to be issued over time, the ability for someone to pay back their debt over the long term, or this question around inflation. Inflationary risks, you typically want to get compensated for taking longer term exposure there. So that's the idea behind getting paid to lend longer versus shorter. And again, we try to incorporate that into the analysis. So, 0.5% real rate plus 1% of a term premium gets you to 1.5%. And then what's your expected inflation rate? Now, if it was a 2% target, you're at 3.5% by adding those numbers up. If you think you're in a higher inflationary world, maybe a 0.5% more inflation, now you get up to, if I'm doing my math right, a 4% type fair value. So that type of analysis we'll look to do to come up with a long-term fair value type rate.
So we've hit about the halfway mark. So far, so good? Doing okay?
Yeah. Good, thank you.
Yeah, I think so. Yeah, I think we're doing good. I want to ask, obviously, when you took over for Bill Gross, big name, big personality, A lot of financial advisors listen to this. Small business owner, financial advisors. When you took over, obviously, a bigger company, what are some of the things you learned from that? Like, what are some, maybe a failure or a success that you learned taking over that someone who run their own company could really leverage and continue to help them grow?
First of all, I learned a lot from Bill Gross. That was incredibly helpful to be able to step into the leadership role, and I think it's a lot more challenging to actually build a company from zero AUM, to $2 trillion of AUM, while generating strong investment performance, than maintaining a firm that already was very, very well positioned for future success. So I think the degree of difficulty much lower than what Bill dealt with, and I think one of his greatest accomplishments was building PIMCO. But one thing I've learned is to be flexible in your approach to management. I mentioned earlier, have a great set of teammates. We've worked together for a long time. We don't always agree in a narrow sense, but have tremendous respect for one another. And very, very early my time overseeing the portfolio management group, I just even more appreciated the need to lean on my colleagues who are better at certain things than I am. I learned from them tremendously. So again, it's been a team-oriented approach. Also, I think you always learn that what you spec out on paper is different than how the world works in reality. And again, I think you need to listen a lot as you take on more leadership responsibilities. Listen and learn. And even when I've had the right strategic decision, I haven't always implemented properly. Sometimes you have the wrong strategic decision and you get a little luck in your favor, or vice versa. So I think it's important to step back and look at the decisions you've made and try to learn, particularly learn from things that haven't gone as well as you desired. So it's been trying to learn from a lot of good people at PIMCO, a little bit of external advice, treat people with respect, and again, really, really leverage team, because it's hard to, regardless of the size of the company that you're overseeing, it's just tough to do things on your own without leveraging the great ideas of others.
On that, like, PIMCO has always had amazing access, and we've found that very useful when we get your notes, access to policymakers, right? People who've been at the Fed, including a former Fed chair like someone like Ben Bernanke, who's on your investment committee, and is there to help you all make think about the long term and decisions, things like that. But how does all that translate to day-to-day portfolio decisions? It's one thing to have like the models that are like, oh, we think the world is going to go in this direction versus that. But then when it comes to, okay, now I need to buy and sell certain things, how do you translate that to portfolio investment decisions?
Yeah, that's a great question. And again, we want to, I'm a big believer in the behavioral finance literature. And what's very, very important, when looking at that literature is to make sure that you're getting good outside contrarian views. And it's always hard for younger employees that aren't, in leadership roles to be fully able to disagree with the boss. I think having an advisory board member group, Ben Bernanke, Gordon Brown, others, you're talking about, highly accomplished individuals with global perspectives, different perspectives, some coming from the political world, some economists that aren't shy at all of sharing different views. And we look to leverage that group on a regular basis in testing our conviction levels, providing us with unique insights. And at times, their views will be sufficiently different from ours in the markets that they really, really sway our positioning. I remember, back several years ago where our advisory board had a much more constructive view on China. This is back when China was growing at very, very high numbers and had accelerating growth. We had been a bit more negative about China. They convinced us we should take a fresh look, be more optimistic, and that was literally the difference between maintaining strong global growth over that period. We made a lot of money from their specific insights. More often than not, they're subtle views, they're contrarian views. They help us just think about how we prioritize our own internal meetings. They just help give us a fresh mindset. So it doesn't necessarily mean we meet with these folks and it turns into an actual trade. It's really just helping us understand research priorities and perspectives we should be entertaining as part of the overall process.
Fascinating way to think about it. Like, you have all the outside folks coming in to almost like break open your little bubble, or of the investment team and things like that.
That's right, and Dr. Bernanke chairs that committee. They meet on their own with specific instructions to not be swayed at all by PIMCO. So we will have typically one PIMCO individual there that simply serves as a facilitator or a moderator. They don't enter the discussion, they don't prioritize the discussion. They're there literally to take notes and just make sure we adhere to time and that everyone gets to speak, basically.
And when you see that, you're like, oh, I didn't think of this. This is interesting.
Yeah, that good example of how it works.
When we talk about bonds, let's circle around. Is now, you think, a good time? Obviously, it's been a rough go for bonds. We know that. Is now a better time for your average investor to think about going out in duration, adding some bonds? And then part two to this, is bonds still one of the best diversifiers for stocks, right? A lot of people listen to this, focus on macro and equities. We don't focus on bonds as much. But do you think bonds, because lately both have been going down to a degree. I mean, last year they did, right? And we've seen other periods when stocks have sold off, bonds have sold off, obviously, with the higher yields we're getting at. So what is the best diversifier still for stocks, and what do you think about bonds right now?
Yeah, so they've been far less of a diversifier. And over extended periods of time, they haven't been a diversifier at all, which has been a challenge for bonds. It's been a challenge for stocks. It's just been a challenge for investors looking to come up with an appropriate asset allocation. But to answer your first question on value, there's great value in the fixed income markets for a longer term investor. And what I mean by that is that they can certainly get cheaper tomorrow. There's no guarantees that we don't see further weakness over the short term. But what's great news about bond markets is that the starting yield is a phenomenal predictor for the forward return over a 3 to 5 year period. So if you look at the 5-year return correlation versus starting yields, it's above 90%. Not surprising, because if you put together a high quality bond portfolio, you earn your coupon and you ultimately get your money back. You could put together a high quality bond portfolio today without a lot of economic sensitivity, and you can generate yields in the 6, 7, even 7.5% type range. If you hold that portfolio, like we do in a lot of our funds, or you do it in a ladder construct as well, you are highly likely to earn that 6, 7, 7.5% over the next 5 years. That historically has looked very, very good versus what you will typically earn on cash. It also looks darn good versus equities as well. You compare fixed income to equity valuations today, they look quite attractive, under popular valuation frameworks. And back to this correlation piece, locally or over shorter periods of time, bonds have not provided insurance benefits. But you only have to go back to earlier this year when the SVB crisis hit the markets. Yeah. You had a massive and powerful rally in the fixed income markets, particularly in the front end of the curve. As inflation gets more under control and heads towards central bank targets, and if you see even some modest economic weakness, we do think on a go-forward basis, correlations could improve, meaning that fixed income begins to help reduce volatility in a portfolio. That's sort of icing on the cake. Sure. Even if it didn't, there's reasons why you want to enter the fixed income market.
Still get the yield,
to lock in those higher yields. But we do think correlations will get better as the inflation situation gets more under control. Now, similar to the earlier point as to whether we're in a new paradigm, we very well may be. I don't know that we are going to have the same insurance characteristics in markets like we had pre-COVID, because with inflationary risks being a bit more balanced, we're likely going to have periods of more volatility and where these correlations break down, at least relative to where they were pre-pandemic. But that can be a frustration for a more static asset allocation type framework. It's great for active asset management. Volatility, two-way risk, less synchronized cycles, more volatility in absolute inflation levels, relative inflation levels. That's real good for the relative value opportunity set, but it may not be as neat and easy as it was for clients looking to allocate between different segments of the market.
Right. So, you mentioned like high quality credit, just taking the other side of that, like the stuff that's not high quality, right? What are you seeing there, and are there any worrying signs there with respect to, high yield, the high yield market, where, companies that are less well rated rather than your Apples, JP Morgans of the world, are they finding it harder to borrow, and what does that mean for the economy?
Yeah, so there are concerns. We mentioned earlier that, a lot of companies were able to term out their debt. Mm-hmm. They didn't term it out to infinity. They didn't even term it out for 30 years. They bought themselves some time where, maturities are not this year or not next year, but they're coming in the next few years. And if rates remain elevated, companies are going to have to roll that debt, and that will be a challenge, particularly if it's occurring, into a weakening economy. But it's certainly bought corporations some time, and initial conditions are pretty good in the investment grade market. They're actually pretty good in the high yield market. Today's high yield market is not like the old high yield market. Leverage is lower, inherent credit quality is better. A lot of the more aggressive lending has migrated into the private credit markets and into the senior secured loan markets. They are very, very different. And they're different in that they are entirely floating rate markets. The investment grade and the high yield markets are predominantly fixed rate, so people have been cushioned from central bank policy rates going higher, but it is a concern in the senior secured loan or the private credit space where you have floating rate debt, where companies are they're feeling the full brunt of central bank policy tightening, and they're being forced to pay higher and higher debt service on these loans that they took out in a very low rate environment. You're already beginning to see some weakness in financial metrics there. You've seen elevated downgrades and defaults, and we think the longer the Fed stays at these higher rates, the more challenges you're going to see in those areas of the market. Commercial real estate, a very, very similar dynamic. So we are most cautious about senior secured loans in segments of the legacy private credit markets. High yield, spreads tightened a lot since the regional bank risks have dissipated. At current spread levels, we're neutral to a little bit biased to reduce high yield on the margin, but not wildly concerned. We think their, credit quality's held up reasonably well.
So I think we have time for one more question each. We're nearing the end here on the latest Facts versus Feelings podcast with Dan Ivascyn, the Group CIO at PIMCO. My last question is what I like to ask a lot of times. You mentioned Bill Gross already, but maybe let's go somewhere else. Who's a mentor or two of yours over the years, and what have you learned from them?
Well, professionally, it's Scott Simon, who used to run our mortgage desk here at PIMCO. I've been here 25 years, just hit my 25th anniversary.
Congratulations.
Thank you very much.
The company's 52 years old, I believe, right?
The company's,
right
a lot longer than
You've been here half the time, though. That's pretty good.
It's been around a while, but I think we're actually been around a little longer than that. But when I started, though, like a lot of MBAs, joining a firm with a demanding culture, it was rough. I had learned a lot in school, but as we know, actually trading markets is a little bit different than what you learn in the textbooks. So I was struggling a little bit, and Scott Simon, came in. He had been very, very well regarded researcher and trader in the agency mortgage market on the street, and he gave me a lifeline. Not only pulling me back into the fold here at PIMCO, but also just really allowing me to grow within the organization, supporting me early on in my career. There's other people on the sell side, a gentleman named Jonathan Pierce, who's been still working in the business. That was always helpful to me as well. So professionally, you always need a lot of luck and great mentorship. Those are two examples. On the personal front, my parents were phenomenal. I grew up in a small town. Not a place where a lot of people get out of the community and move into this sector or this particular industry. Just had a lot of support early on in my lifetime. Value of education, providing the ability to get the education required to do this type of thing.
Can I ask where you grew up?
I grew up in Oxford, Massachusetts, a small town outside of Worcester, Mass.
The opposite end of the country.
Yeah, and I'd actually like to head back that way at some point.
So you still a Patriots fan?
I am.
Okay.
I hope we lose every game and get a good draft pick now. So we're in a different mindset right now. But I absolutely over the long run
has
want them
that
to do
over,
well.
right now.
Yeah, we're in a battle for the worst, the worst record, hopefully. But yeah, all the Boston sports. Although I've grown to like the Anaheim Ducks out here because it's fun to go to live hockey. So that's fun for me and the family.
So one more question?
Yeah, go ahead. Final one. Make it good, Sonu. Make it good.
No, I'll bring it back to bonds and why hold bonds. And one big reason is what we got to earlier. You want bonds to zig when stocks are zagging, usually, and it gets to that correlation benefit, right? And you talked about maybe that's going away. But we just saw, a couple of weeks ago, the tragic events in Israel. You have geopolitical events, and, Treasury interest rates, Treasury yields went down. Right? It was almost like, everyone wants the safe asset. And that safe asset has tended to be U.S. Treasuries, right? Will that continue going forward? Are U.S. Treasuries the safe asset that everyone would want to hold?
Yeah, so I've been making, I guess it's a little bit of a joke. I said maybe we can't call Treasury the riskless or the risk-free rate with the recent downgrades and our current deficits. It's certainly a low-risk rate. So over the near term, we still think that Treasuries and the U.S. dollar will benefit from flight to quality flows. Now, it requires more nuance in a world of elevated inflation, but when real bad things happen, we do think there's going to be a rush to higher quality bonds. And I think that's the additional benefit you get from yields being as high as they are today. In addition to that predictable, attractive return for someone willing to hold for a 3 to 5 year period, you also get the potential benefit of price appreciation when really bad things happen. Now, of course, the events in Israel are tragic. We don't want bad things to happen, but when they do in this world, we do think that there are plenty of scenarios where at these yields as a starting point, you could end up getting a rally at the same time that other areas of your portfolio are selling off, because typically stocks, when people worry about the world, they go in the exact opposite direction. So that may not be as strong a relationship as it was in the past, but we still think for the foreseeable future, U.S. Treasuries and other high-quality U.S. bonds are going to have that type of performance potential.
Almost like an insurance potential.
That's correct.
I think it's a great way to end it. Well, Dan, thank you so much from Sonu and myself. Carson Group, obviously PIMCO is a tremendous partner. Means a lot. I know the listeners are going to love this podcast as well. And everybody, we'll be back next week with the latest facts versus feelings. But this was a really good one. Thank you for joining us.
Thank you guys. Really appreciate
it.
Thank you.
Information provided on Facts versus Feelings with Sonu Varghese and Ryan Detrick are for general information only and are not intended to provide specific advice or recommendations for any individual. The statements and opinions of show guests may not be reflective of CWM LLC or its affiliates. Past performance is no guarantee of future results. All indices are unmanaged and may not be invested in directly. Investing involves risk, including possible loss of principal. No strategy assures success or protects against loss. To determine what may be appropriate for you, consult with your attorney, accountant, financial or tax advisor prior to investing. Guests on Facts versus Feelings are not affiliated with CWM LLC.